But in reality, like most small businesses don't have enough data at each price point in order to project accurately on it.
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today, as the Edmonton business consultant, we're talking about the business plan and specifically the customer acquisition objectives. I have Denise here with me again. Denise, how you doing today?
I'm good.
So Denise, we're almost at our 8-year anniversary.
I know.
It's been so long, hey?
Yeah. Seems like it.
Remember anniversary one. So
Yeah.
The quote that we have here today, it's a Tim Drucker quote who wrote 39 business books. And he says, nothing happens until someone sells something. And the statistic that we have, or 50% of all Canadian businesses will go out of business in the first 5 years. And 42% of these business owners will report their inability to attract enough customers as one of the primary reasons for their failure, making the inability to attract enough customers the most common reason for business failure. Now, the story that we have here are business owners, they often develop business plans with revenue projections. However, the revenue projections aren't tied to specific number of customers. So Denise, you've seen this. So what are the questions that these business owners should be asking?
Yeah, so I think the first question is, does tying projections to expected per transaction amounts increase accuracy?
100%. Yeah, what you want to do is, we don't just want to have revenue projections out of nowhere. We have to understand, for each dollar in revenue or each $1,000 in revenue, how many customers that is. And we look at it on a per customer basis. So customer 1 brings in on average this amount. Customer 2 brings in on average this amount. And then when we extrapolate those number of customers, we can get, really reliable revenue projections because, the customer numbers itself has to make sense, if you will.
Right. So do most businesses have a wide variety of price points?
Yeah, most businesses have, a big menu, as I'll call it, right? They have the appetizers and the main courses and the desserts. No matter what business they're in, they have, a wide variety of price points. There's not just one price point. It's not just, you're not selling just widgets for a price of X. Usually, almost every business we deal with has a wide variety of price points.
Yeah. So do most small businesses have enough data to accurately project each price point?
No. Here's where we go wrong a lot of times. Where the small business owners, they start getting all of their price points, and maybe they have 5 price points, 10 price points, 20 price points, maybe even 100 price points. And they're trying to make projections on each one of those price points. But in reality, like most small businesses don't have enough data at each price point in order to project accurately on it. I make the example all the time about onion rings. And, the average small business owner trying to project if they had a restaurant, how many onion rings they're going to sell. They're not A&W. They're not selling millions of orders of onion rings. They really need to know those averages more.
Yeah. So speaking of averages, will average price points be more reliable in predicting the future?
Yeah, so the averages, if we boil all those price points down and start taking some averages, those averages are very likely to recur. Even small businesses, they've all seen, dozens or hundreds or maybe even thousands of customers at some point. So even though they haven't sold, dozens or hundreds or thousands of items off of each item on the menu, they have generally for the customers. So those average price points will start to become really reliable, and the average in year 1 will look very similar to the average in year 2, and that helps you make accurate projections into the future.
So should you group transactions with similar margins?
Yeah, so that's generally the goal. So although we don't want to plan on every item on the menu, so to speak, we want to group certain items that have similar margins together. Let's say if you're a medical facility, for example, maybe you're a dentist or a family doctor, and for every exam, you pay out 70% in locum fees. I guess that would be a little high for dentists and right on the mark for family doctors. But, for every dollar that you bill the patient, you're going to pay out an X percentage to a locum doctor. at the end of the day, they have the exact same margin. If it's a basic exam that's, $80, it's, your margin is 30%. And if it's a comprehensive workup and it's a $500 bill point, it's still your margin is 30%. So it has that similar margin, so it can be grouped together. But for example, if that, same clinic starts getting into selling supplements or selling some sort of product, that revenue stream will have a different margin altogether. It has a different cost of sales because they're actually selling a product or good. So that revenue stream will probably grouped into another grouping, if you will. So you want to look at every opportunity to group transactions with similar margins together. It doesn't matter if they're big and small. You can group them together as long as they have similar margins.
Right. So now you have these groupings. How many groupings will most small businesses have?
I would suggest that most small businesses have between 1 to 3 groupings. So a lot of small businesses, they can group them all together. There's a lot of medical clinics that we see, and they just have how much do they make per patient visit. That's the grouping. And whether it's a simple $50 exam or a $50,000 treatment, it's a similar grouping with a relatively similar margin, right? But if they're selling maybe a product, that might be a little bit different, right? Or if they get some of it from Alberta Healthcare and some of it are private patient pays sales, those margins might be different, right? And we look at our construction clients. They might have a one-day $200 job that they go out there for a service call, or a $200,000 job. A lot of them can be grouped together, and we see a lot of our construction clients where it's it's service calls, where they it's called on the phone. They dispatch their technicians, whether it's plumbers or electricians or carpenters or whatever it is, as opposed to the projects where they go out and bid the project, and it's a multi-day project, right? But you can see in a business like that, we're only talking about 2 groupings: the service call and the projects that they're building, right? Or maybe they might have different project profit margins for the residential work as opposed to the commercial work. But the idea here is the simplicity. The simplicity of the groupings. The fewer groupings that you can get that are somewhat similar, the more reliable your projections are going to be. And some people think that it's the opposite of what's counterintuitive. Some people think that, well, just because it's more comprehensive price lists, actually the more comprehensive price list, because we don't have enough data, actually tends to be unreliable transactions. But if we can get really simple groupings, those average points tend to recur, and we can get really reliable projections moving forward.
Great. So should you identify the average price for these groups in the executive summary?
Yeah, I think it's first and foremost, it belongs right there in the executive summary. We're normally looking at the problem, vision, mission, and values of the business, number 1, and number 2 in that executive summary, right at the front of the business plan. We want to have the average price for revenue group 1, and if there is a group 2 or group 3, we're going to put it right in there. Let's make it really tangible right from the start of the business plan, because everything flows from there.
Cool. So should your customer acquisition objectives predict on these same groupings?
Yeah, so that kind of flows through. So we start with it in the executive summary. We start with the prices and the margins on it, and then when we're looking at acquiring customers, we're looking at acquiring customers in those 1 to 3 groups at those exact price points that we've already demonstrated, or the ones that we're predicting for the future. So those price points, they flow right through to the customer acquisition objectives, and they make them more real and more likely that they're accurate, an accurate source of predicting the future revenue.
So should you separate expected sales from repeat and new customers?
I think it's really valuable, because there's a certain amount, a lot of businesses, they're going to generate repeat customers from their existing customers. Even in, businesses that aren't, a recurring model, like we get, general contractors, and, people don't, renovate their house every year. But they will, tend to hire a general contractor every 3 years, or maybe every 5 years, depending on the size and the scope of the work that general contractor does. So there's a certain amount of business that, if you mine your database effectively of your existing customers, are likely going to recur. But then we want to identify how much revenue needs to come from new customers, because that tells us, how much time and effort and money we should be putting into these advertising initiatives. We want to make sure that efforts are worthwhile, and at the same time we're putting enough effort in to get those new customers, right?
Yep. So why do your business plans only project 3 years, with year 1 being the current year?
I think it's a little bit unreliable in most small businesses to go longer. I see people, sometimes they go 5 years. It tends to be the other conventional norm, but I even see crazy ones where people are projecting like 10 years into the future, which I think is just absolute insanity in a small business. To predict 10 years out in the future. I would suggest that even predicting 10 years out into the future in a lot of big companies is a little bit of insanity. But I think 3 years is it. So keep in mind, like year 1 is the current year. You're already planning. If you started planning, this business is already incorporated. Maybe you're starting from 0, or maybe year 1 is the year you're already operating in. So you're a quarter of the way through the year, halfway through the year, 3/4 of the way through the year, and you're really projecting 2 years in the future. And I think that's long enough, really. I think that gives them an idea, and I think most people should be redoing those projections every year, because you're going to learn so much about your business and where you are, and circumstances will change. So I think 3 years is kind of the maximum, keeping in mind that year 1 is really the current year. We're really just finishing off where we are in the current year, and we're projecting 2 years in the future. I think that's long enough. That starts to give you a trend, and it starts to help you think about strategically, maybe accumulating new cash to buy out a building or major equipment or something like that, but not so long that it just becomes guesswork.
Yeah, that's right.
So I think that's what we have here today. Thanks so much for joining us again. As always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And as always, we look forward to any comments that you have so we can respond back and use your input for future videos. Thanks very much.